Welcome to the Dividend Talk podcast, 2023 earnings season. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. I'm your co-host, Engineer My Freedom, and today I am joined by European DGI. So sit back, relax, and join us as we dive into the world of dividend investing and discover the power of passive income. Hey, European DJI. How are you, buddy?
I am really excited because earnings season has started. Finally, we can get all these dividend hikes from the European companies thrown in our face. And it has been already a great start, I would say, but more about that later. So I feel really excited. Earnings season, specifically this time of the year, is really exciting for me.
Yeah, I feel a little bit bad because usually we record on a Fridays, which means we get the full week, usually. But me and my travels, I'm traveling out and going away again this weekend. I'm going to kind of a remote part of Ireland, so there's no signal, so I'll be off the grid for about 3 days, which is good. But the downside is we have to record a day earlier, so we're missing some earnings. But hey, we got some great companies that we can capture that reported their earnings on Tuesday and today. So let's
But
roll them out.
that's funny that you say it because now I've been in Ireland, and the fact that you say remote is really interesting because for me, where we were already was already end of the world. So how much more remote can you go? You mean like off the grid?
I mean, the phone will not work. So like nothing will work at all. So you will not be able to contact me even if you tried. That's how remote. And it's like a little cottage in the middle of the mountains, and there's only mountains and lakes beside you. There's not a whole lot. So we'll just spend the whole weekend walking, maybe get into the water
Yeah.
and so on. But it'll be a nice little break.
Well, take some of those fireworks with you. That when there's SOS, you can shoot them up in the air so that people know there is an emergency going on.
Yeah, they still won't be able to find me, but I'll bring them along anyway. But hey, while we're here, Facebook 1,000 members. We asked for that 2 weeks ago. I think we were so close, and we finally passed the mark. I'm really excited about that. It's a huge milestone for us in our community. So thanks to everyone who has joined us, and I'm liking it now. I'm a little bit more active lately. I've downloaded the app on my phone. I didn't have it before, so it's growing. It's growing nicely.
Yeah, and what I like about it is that there's really the European flavor in there. And sometimes people ask, for instance, information about a stock that I've never seen before, right? And because there are some other Facebook groups also around investing or dividend investing, but they over time merge into any investing topic, right? And I hope we can kind of keep it to dividends in this group, because that's really what sets us apart, I think, also with the connection to Dividend Talk and this European flavor. So for me, seeing this with 1,000 members is really a nice milestone, and I think it's a testament to all the great stuff that the community is doing. Yeah, it's really like our moderator Alex. We really need to call him out. I don't know if everyone noticed it, but he's often really deleting spam posts that are coming in really quickly. So he's doing an awesome job as a moderator. If you don't know him, he was like few shows back on our podcast. We can put the link actually to that podcast in the description. Really awesome guy. So Alex, I mean, this is maybe even more on you than on us, the fact that this group is really well maintained. So thank you, my friend. And to everyone, well, really thank you for joining and being active there and being a member. It's really, really great for us.
And do you know what else it does? It makes, well, my life or our life easier when it comes to news of the week. Because this week, one of our retired early members, Chuck, posted about
before you
Chevron.
go there,
Go.
let us know when you are already experiencing fire in the community, because we made a group status. Everyone who is already early retired because of financial independence, gets a special status in the Facebook group called Retired Early. And we want to celebrate it because this is really, for me, when Chuck mentioned it, like I am now fire. And the response to that, that's what's the inspiration part here, right? So, Chuck, I just wanted to call it out. You're the first retired early member of our group with a special status. And anyone that can prove that they're also fire, announce it and you will get the status from us. But go on, Derek. Sorry.
Yeah, go back to it. I said he was making my life easier. He announced, I didn't read about it, but Chevron, ticker CVX, I'm getting better at remembering ticker names, is buying back 75 billion worth of shares. And they also threw in a dividend increase of 6.3%. I mean, that's 20% of their company they are buying back right there. That is just mind blowing.
Yeah, and it's fair to say, right? This 20% is probably over the course of a few years because their last buyback program, I believe, was 25 billion and announced in 2019. So it took them like 3 years. So let this be also 3 years. It's still like 6-7% on the current valuation annually. But look, Chevron is, for me, a classic story of investing a lot because in 2016, they had their first projects coming online, and these were heavy capex investments, and now they're really literally plucking the fruits from it. And who could have seen this oil boom even coming, right? So
Yeah.
I mean, Chevron, it's probably even, I would argue, the best managed dark oil company of the pack. Yeah, and amazing.
Yeah, I mean, as I said, it's mind blowing. What came to my mind was, first of all, valuation. Right now is now the right time to announce that, given that they're so high in valuation. And second, have they really got nothing else or nowhere else they can invest that money? Surely they could, but obviously not. But we know it's cyclical, but at all time high, it's hard to justify buying back. And as you said, I know it's going to be spread out over a couple of years, so hopefully they'll
Yeah.
average down when they're buying back.
So once all the oil majors have announced their annual results and then the annual reports are online, I will do again a comparison on YouTube, which I do every year to see like how they are progressing. So someone asked about it. So here already my commitment to continue doing that because I'm really long oil and gas. And I think these are just jewels of companies that I think some of them really deserve to be in a portfolio. And look, last year I had like, what was it? Really small growth in performance, right?
Yeah.
It's only because of energy. Energy has been my hedge in my portfolio. And that's how you need to look at it from a diversification point of view. One time it's this, one time it's that. But overall, it keeps your portfolio relatively stable while there's volatility in the individual names. And oil just, in my opinion, still really belongs a good space in there.
Yeah, of course. Oil is not dead. Let's make that clear. It's not dead.
Oil, baby, oil. Drill, drill, drill.
Okay, earnings. Let's try to get through this. We have a couple of really good companies, and I think it's no surprise that we start with our darling Microsoft, ticker symbol MSFT. For me, I'm going to read out the headlines first. So to get the headlines, so they have revenue up 2% to 52 billion over the last 12 months, operating income up 8% to 20 billion, and net income was down 12% to 16.4 billion, which obviously reduces the earnings per share. Reading through the report a little bit, it's like a football game. It was like a game of two halves. Okay, so you had the weak side and then you had the strong side. The weak side first is obviously in their personal computing. That took a massive hit, and it was expected. I don't know if it was expected to be as big as it was, but it was certainly expected to have some sort of slowdown, particularly coming out of COVID and the slowdown in buying computer. People having a lot of cash hanging about, and they're certainly not buying Surface Pros or anything like that coming off the back of that. So that was a little bit expected. The good side then was their cloud growth. I mean, their cloud growth was exceptional across all areas of the business. We look at cloud revenue was up 22%. Azure revenue was up 31%. I mean, they're just really big numbers, aren't they? Particularly in a year where technically they've struggled. If you get me, I tried to make a rule this year not to look at the share price before I read the earnings. So I stayed away from looking at anything over the last 2 days, and even from Twitter for that reason, because I know a lot of people will look at the share price and might base it on the share price. Maybe it was good or maybe it was bad. But honestly, I know they had a weak consumer segment, but everything else just looks absolutely perfect in my eyes, particularly the cloud growth. Um, going through go through their income statement. Look, the cost of revenue went up, understandable. Cost of materials, which they said, which drove the net income down. There was some general and administrative expenses, and research and development went up, but nothing in there that was to worry me. Inventories is the only thing that has gone up significantly. I think it's gone up nearly threefold. So it was 394 million. It's now just over 1.3 billion. Again, I think that's a trend we're starting to see across nearly all sectors like this. I wouldn't say it's worrying, but it's obviously going to have some sort of impact on their cash flow. But for me, they're starting to come. I'm expecting this kind of a cycle over the next 2-3 quarters where we're going to have weak consumer. I think even the business end is going to struggle a little bit. I think we're seeing lots of layoffs now, and businesses are going to start tightening their strings. Not so much in this quarter, but definitely in the next 2 quarters. I think that will drop along with the personal computing. Cloud growth will probably hold it steady. But I think as a result, we might start to see the share price come down, up and down over the next 2 or 3 quarters, but they're starting to come down to a very, very attractive price. I think the forward PE ratio is 24. If that gets down around the 20 mark, I'm back buying again.
Yeah, same here. And you know what I love about us just reading these quarterly reports, because they have the annual cycle always ending in the summer, is that we know already that Intel's earnings in 1.5 hours from now, actually, because it's Thursday today, will be bad. Yeah, that's my
Yes,
expectation on this one.
yes,
But on the other, I need to give credit to Pat Gelsinger as well, because if I'm not mistaken, it was he who said in like 1 or 2 quarterly reports ago, like, look, the corporate hiring was one of the boons for the personal computers to grow so much also, right, during COVID. How many people were being hired in these big tech companies? So, and so there's a lot of corporate spending on that. And if they are firing people by the bushes now, a lot of equipment will be left. And what happens in those companies, they will not acquire new equipment for things that are getting end of life cycle. They will just reuse those ones that were used by former employees. So they are kind of building up an inventory. So I think we will see this a little bit longer, actually, if mass layoffs are happening everywhere in the corporate. So it will be really like, oh, my ass will be sweating with the Intel numbers. But hey, I'm in it for the long game. Look, what I love about Microsoft as well, right? Still now, they have on the trailing 12-month numbers, they have 59 billion free cash flow, 19 billion in dividends, 28.5 billion in share repurchases. So that means that about still, now what is it? Let's say 18, 19 billion is left. Yeah. What have they done in the last 12 months? They have reduced long-term debt by 14 billion. So this, I mean, even with these repurchases that they are doing and everything, they are still massively generating cash, and their balance sheet continues just to strengthen and to grow. Equity to shareholders, just to mention, it was 183 billion right now. Back in 2017, it was 72 billion. Yeah, so 2.5 times more value to shareholders in equity. Yeah,
yeah.
that's compounding at a rapid space, and the share count is slowly decreasing. So for me, I mean, I love the company, and on a dip I might nibble a little bit in to just expand my position, because like to what you say, a PE of 24, 25 is, in my opinion, the ultimate example of a Warren Buffett quote: buy high quality companies at a fair price. And if you mix this in with another purchase I did today with a stock that we will talk later about, also my average yield on acquisition is relatively nice. Yeah, then you buy a bit of high yielder, compare it with a compounder like Microsoft, and my portfolio will generally do well and meet the targets.
Yeah. My only thoughts when I was reading through the press release and the slides was there, they talk a lot about cloud and their focus is really cloud and AI. They're really
Yeah.
pushing that route. So could you possibly see some sort of spin-off in the future where they spin off the kind of slow going cyclical nature of the personal computer business and then really try and drive growth in the cloud AI?
Well, I think this happens because they created a flywheel. Yeah, don't forget that personal computer, if they have that, the hardware part allows them to understand really the impact of the software part. That's also why Apple likes hardware and software. And they also have Office 365 and all this stuff, which really needs to integrate well, also of course, and performance-wise. So I do believe it's not smart to do it. It's all part of the flywheel. But I could see if they come to a phase where the growth is ending and it becomes more about shareholder value at that moment in time and capital return, then I can see spin-offs happening because this is now really a holding company, LinkedIn, but it's so deeply integrated with each other, right? And the flywheel is really now at the moment around the cloud.
Yeah.
But you need this whole ecosystem to drive it. Also, the investment in OpenAI. They have now an exclusive agreement to only leverage Azure. What happens with that? They get to learn everything about how to tune Azure towards those AI models. At the same time, it forces potential customers to use Azure. So for me, it's a brilliant strategy. And I don't see that in the next decade yet they need to spin these kind of things out because it's all compounding on each other, all building
Yeah.
on each other.
A flywheel is a good analogy. And you know what? I realized I didn't even mention LinkedIn. I mean, that grew 10% as well. I find that
Yeah,
crazy.
yeah. And I mean, if you know what they paid for it and you see the annual cash flow coming out of it, it's already crazy. Yeah? It earned itself already back. And then, of course, they will get Activision Blizzard into this ecosystem with a little bit of luck if it gets approved.
Potentially,
And,
yes, yeah.
60 billion, I mean, on their balance sheet, it's an afterthought. Yeah. And even a 10 billion open AI, they do it just out of pocket this year. It's like
Yeah, just
literally like keep the change.
keep the
It's
change.
yeah, yeah, on one of the hottest assets of the last weeks.
It's look, they're cash rich, and as I said, they're definitely coming in to more my fair value range, and I'm getting close to loading up the truck.
And the irony of this all, Bill Gates, to my understanding, just acquired 9 billion in Microsoft shares as part of their philanthropy. What is it? With the Bill and Melinda Gates Foundation. He bought 9 billion in shares in a company that he founded.
That's wow.
Exactly.
Wow. I did not know that. I did not know that.
Yeah. If my understanding is correct, that's what happened the other day because you have these, I don't know if it's a 13F, but they need to mention that, right? And they have an investment portfolio because that needs to pay for the foundation.
We talk about the psychology of averaging down. So when you buy averaging up on a company, okay, so you're buying a company and the price goes up and you struggle to buy it. Imagine being a founder of a company and then having to buy 9 million shares. That's psychology. That is psychology.
Yeah, that means also that you have character.
Exactly, and pretty
believe
big
in
boards.
your in your successors like Satya.
Yeah. Okay, let's move on. We could talk about Microsoft all night. We'll move on to. I'll let you go with the next company.
Well, I think we have to just talk about ASML. Yeah, it's a darling, I think, in the European dividend community. I realize for Americans, it's a little bit like this awkward company that some people talk about somewhere there in the Netherlands. But ASML, also ticker symbol ASML, listed on the Dutch stock exchange. I mean, we spoke about this a few times already. They have a monopoly with all the how is it, the equipment machines they create for the chip industry. Yeah, so TSMC, Intel, they pay billions of euros towards ASML to get their latest technologies. Even Intel and ASML have an agreement where Intel did like a large pay up of several billions to be able to get the first Nano 3.5 or what was it machine. And I mean, they had amazing numbers again. So they got a bit beaten down earlier in the year because of the fact that they had some. What they did is they needed to ship faster, yeah, to their customers. So with that, they have later revenue recognition. So what it means, I believe they install the devices now, the machines at the customer site. And when we say a machine, guys, it's not like a machine like, I don't know, installing a kitchen. No, these are highly specialized machines, as large as probably 2, 3 bedrooms together at times. They need to stand on a special surface that is shock resistant, because one little microshock can already disrupt the whole production of this. So these are heavy specialized buildings. And so they had to install them there. And with that, also later revenue recognition. This year, they sold 40 of those expensive EUV machines, but they shipped 54. So those 14 will probably be accounted for this year. It's important to know that, to realize that. But still, then the margins are pretty decent again. They had a net sales in 2022 of 21.2 billion at a 50% gross margin and a sales growth of 14%. 14% is relatively low, let's say, for ASML, but this was already known since half a year ago with the half year
Yeah.
results. So if we go to the outlook, for instance, they expect, I believe, a 25% sales growth, net sales growth in the upcoming year. What I really loved about the numbers, actually, is if you look at the memory business, it has been growing really a lot, from 4 billion to 5.5 billion, so 1.5 billion extra. The logic business was kind of flat,
Yeah.
but here's where the cash cow comes in. Because do you remember what they always said with Apple and the App Store? Yeah, that where Apple started to build really lots of recurring revenue with this, with the services that they are creating. ASML has a similar model. They went from 2.6 billion in 2018 to 5.8 billion almost right now in install base management. Yeah, and what I like about is that it feels like the share of revenue is increasing there. And I also know that sometimes they resell old equipment and such to other manufacturers again. So they're really smart with this, and there's a lot of money to be made there. And I really think they are nailing it on every side. Yeah, and then so I'm really excited about ASML. I own one share, right? One share, but as a token of respect for this company, I wanted to buy more if it would hit 400. It didn't. Okay, maybe I should have. But on top of that, they announced a 5.5% dividend increase over the fiscal year 2022 from €5.50 to €5.80. But there's a catch here. The first dividend in this quarter will be 1.37, in line with the last 2 quarters. But the final dividend will be 1.69, and that's where the hike comes in. My question is now to ASML, in quarter 3, will this 1.69 be the new quarterly dividend going forward? If that's the case, we're talking probably about a 20-25% dividend hike. That's not
Right.
clear to me based on the press release and such. So that's up in the air. But I mean, also the share buyback, by the way, it was amazing this quarter. And I think what was nice about it, there was a significant price dip. So they did this really well. So ASML, it's for me like it has all the tailwinds, even in this chip industry, it is doing superb.
Yeah, and I want to go back and listen to, I think maybe 6 months ago, because I'm nearly sure you predicted this. I know they shipped 54, but you were saying they were building up this inventory of
Yeah.
14, and they're going to ship it next year. And I think that was, it wasn't the last earnings. I think it was the one before that. So I think you predicted this would happen. But look, solid numbers all around. They've grown exponentially, as you said. There's a lot of good systems there. I'm looking at metrology and inspection. That's kind of an area I'm getting into in my work at the moment. And grew 28%. I mean, company it's a European darling. It's one I don't own. I wish I bought it when the kind of capitalist mentioned them way back. Maybe I was early 2021. But yeah, I wish I owned this company.
I'm just checking the share price, what it did this week, and it is a few percent up. Because with these earnings, I almost don't even check the share prices of some of these stocks. But it's at 680 USD at the moment. So I probably should look actually at the euro one, because that's the one we follow. So 619 euro at the moment. And okay, so yeah, it had a bump up yesterday of 3-4% on the news. I think it deserves much more. And honestly, around 600 euro, it's probably with these growth numbers and predicting it in the future, it's fairly valued in my opinion. It's just like the dividend is 1%, that makes it less attractive, but such, at least I felt I had to own one share of this one, and who knows, maybe a second one in the future.
Yeah. Okay, let's move on to 3M, ticker symbol MMM. It's a company I don't own anymore, but I'm keen to watch them. And I'm sure they're quite attractive to people given the high dividend yield that they have and their history of paying out dividends. So let's look at the headlines. Their sales was down 3% year on year. Organic sales was also down. Operating cash flow was down 25%, while free cash flow was also down 25%. They say this was due to a result of capitalization from R&D for US tax purposes. And they returned 4.8 billion to shareholders in dividends and share repurchases. So this year they didn't cover their dividends and share repurchases. But then if you look at the full year outlook, they are predicting that they will have roughly 5.8 to 6.3 billion next year. So they're confident that they can cover their cash, their dividends and share repurchases. Look, it wasn't a great earnings trend, but it's kind of expected. We can see everything is starting to slow down. There's a general slowdown everywhere, so I'm not surprised that we're starting to see that. Inventory is building up quite highly. Demand is weakening. There's this legal matter then that's just, it's there. They mention it sporadically, but not enough for my liking.
Yeah.
It's still unclear the impact that that's going to have, and that's my main concern. I can live with the rest. I can understand that the outlook next year is going to be flat to negative. I mean, it doesn't take a genius to work out that that's going to happen. With the cash flow that they generate and the dividend is usually safe, I would normally see this as a buying opportunity for a company like 3M, but I just can't. Like the only thing that they have mentioned here is making progress on legal matters. That doesn't mean a whole lot to me until I start to see real numbers and what's actually happening here.
In my opinion, as CEO, then you're not reading the room.
Yeah.
And also I was a bit disappointed in the analysts here. Look, like you said, I still own it, by the way, but I have a buyer feeling here. I just hope that they get the settlement behind them. If we know what, we just need to know what the situation is, how much will it cost, and then we can leave this behind us and move forward, right? Generally speaking, the balance sheet actually looks quite okay. Yeah, so they can also turn off the buybacks at any moment. That should also not be an issue. If they, let's assume that, for instance, the whole settlements will cost 10 billion. They can afford it. Yeah, they can afford 10 billion. But if it is 25 billion, it becomes another story. Yeah. So that's just what we need to know. And because the dividend is safe. There's no issue with the dividend, because they should just, from one side, if they're really confident about their legal strength, I like it that they are repurchasing shares, that they didn't stop it. However, I don't trust CEOs that are, let's say, who are not the founders of a company or something like that, because what they have are options to get rewarded. So they don't have necessarily the long-term incentive that we might have as a shareholder. So I'm on hold with 3M. I decided not to sell them. I had to really hold myself to not buy more on the dip. But I am proud of myself that I didn't, that I kept my head clear.
I mean, if you take out the litigation, that aside, this would have the perfect recipe.
Buy. Yeah.
I mean, but like
even if I knew it would be 10 billion, I would be hitting the buy button on my mouse, and my mouse would be broken.
Exactly. Look, you have a weak outlook. They're coming off COVID where they had heavy demand. So we know they're coming from a high baseline. They're divesting in Russia. There's macroeconomics going, there's everything going against them. It would be the ideal time to buy these guys. It's just this litigation. It's killing me because I would love to own them a little bit, but I just as you said, we've seen it with Bayern before, and I'm not prepared to get involved until there's some clarity. And that's my biggest disappointment in this. I wanted them to address it a little bit more and give me
Like Johnson&
because
Johnson, they were really
yeah,
aggressive, took it by the throat, and they dealt with it. And 3M got a major blowback on that because they tried it and they got rejected by the judge. So
yeah, they need better lawyers. That's what they need.
yeah, they need the Johnson& Johnson lawyers.
Exactly. Okay, let's move on to maybe Louis Vuitton, another European powerhouse.
Fucking hell. You know, remember Louis Vuitton that they make some, what is it, bags and such, like some leather bags. It's, I don't know even where to start. So guys, 2021, they made 64 billion in sales. 2022, 79 billion in some spirits, wines, what else? Some fashion and leather goods, perfumes, watches, jewelry, 79 billion of this stuff. I mean, we're talking about leather belts here and such. And I mean, 79 billion. That's an organic growth of 17%. And you know what is also nice? They are diversified. They have sales like 27% in the US. What is it? 16% in Europe, excluding France. 30% in Asia. Worldwide diversified. All regions were growing except Asia because of the lockdowns. Yeah, but Europe, I think, was the biggest growth driver, 35%. Now, and what is, if you look at the business units, they sell wines and spirits and everything, but by far the largest business unit is fashion and leather goods. It makes up approximately 40 to 50% of their sales. It was the largest growing segment with 20%. I mean, how many people can afford a Louis Vuitton bag?
Uh, I mean,
If I see them in the shop, I think like, who pays this for it?
and think about what you just said there. Okay, you said China was flat. China was
Yeah,
flat
yeah,
because of
yeah,
COVID. I mean, so
yeah,
this is not even taking China into consideration. When China opens up, this could just explode even more.
yeah, yeah. Definitely, definitely. So, I mean, I'm blown away by these numbers, really, and it's really impressive for me. If we look at, let's say the profit, they have about 21 billion in profit at the moment. I believe it's is it operating profit? Yeah, and they have actually decline in operating free cash flow compared to last year. Now, why is this decline in free cash flow? They had to pay almost 1.5 billion more in taxes this year, but also changes in working capital. So they have like a 3 billion negative working capital. That is typically inflation, inventory, these kinds of things, right? And that's why their free cash flow is effectively down. But we also need to look at the investment part of it. They also invested like 2.3 billion more than normal, so they still have a 10 billion free cash flow. But the I think this is like normal. This has more to do with accounting, and these free cash flows you need to look over the years. Yeah, so now it's the working capital looks worse. Usually the next year it kind of compensates again for that. But last but not least, they had a 10 euro total dividend in 2021, and they hiked their dividend, guys, with 20% to 12 euro. It's one of those, I think, dividend aristocrats in Europe. They spent the total dividend in 2020 was 6 euro. Yeah, so now it's 2 years later, it's 12 euros. So they had 100%. They doubled the dividend in 2 calendar years. It's amazing. The 5 euro was already paid in December. The 7 euro will be paid next. I'm deeply impressed with this company.
Uh, it's probably a company I'll never own, genuinely. But but they obviously have some brand power, the whole lot. Because how can they keep? I'm just looking at the share price now. It hardly dipped even during COVID. There was obviously a dip, but not as much as you've seen with other companies and sectors. They seem to have such brand power. I'm just blown away by these numbers, and all for fashion, belts, bags, whiskey, and
Mm.
well, champagne.
Maybe these shares are owned by old widows of noblemen in France that don't even know how to access their brokerage account.
I don't know who owns them, but oh boy, I wish I bought into these guys in 2015 or something like that, because they've just exploded since then.
Yeah. Hey, listen up. You get them in a 1.5% dividend yield. Not too bad if you compare it with what's it, ASML and Microsoft.
Yeah, it's not too bad, and look, as you said,
Doubling the dividend in 2 years.
they've doubled that dividend in 2 years. So you're not actually, if you bought them 2 years ago, if you bought them in 2020, you're getting them for €300. They're now
Yeah.
800, and then on top of that, doubling dividends. That's
Yeah.
unheard of. Yeah.
Yeah, you would have, what is it? At least a 3%, 3.5% yield now.
Yeah, we could retire early.
Yeah, exactly. But hey, if you believe that the company can do the same going forward, then at a PE ratio of 30 and a sales growth of around 20%, and we're not even talking about net income, then it is not so expensive when you look at that from a PEC ratio point of view.
But that would be my problem, because, and maybe I don't understand their business model well enough. I could not see them continuing this growth, but then their past growth shows that they can do it. So psychologically, for me, I would not be
Mm,
able to invest in these guys for that reason, because I think, yes, brands and so on, that it'll have to slow down at some point. But maybe on my behalf, that's a misunderstanding of their business, because their past performance is pretty sensational.
yeah, yeah, definitely.
Okay, let's move on to our last company, which is TROW Price. I don't know if you had a video or a blog post about them.
Yeah,
You
yeah,
do. They're a company, obviously, that you like. So I'll go through the headlines first. Year-end assets under management was 1.27 trillion. Net client outflows was 17 billion for Q4 2022, 61 billion for the year, and their net revenues was 6.5 billion for the year. So what does that really mean? They give the headlines, and it's quite strange, actually, because most times when they give headlines, they compare it against other years. They didn't do that this time, probably because it's not as strong a year as previous years. I mentioned assets under management. That was down a whopping 24.5%. And
yeah,
you look at asset management companies like that, and it's not surprised that their assets under management down. We see a lot of fears down in the markets. Interest rates are rising. We've got macroeconomic issues all over. So investors are trying to maybe take their cash out, make it more safe. So I'm not too surprised about that. What I did like, and what I really liked, is they have a section called management commentary, and they have it broken down paragraph by paragraph by paragraph, and they explain everything in detail. What is good, what is bad. You come to the asset under management, they say, yes, look, our asset under management is down. To address this, we are going to protect our capacity to invest in strategic initiatives. We focus on controlling expenses and third parties, slowed hiring, and reduced their headcount. So basically, they're telling you, look, they're going to protect their cash in the downturn. They've reduced their headcount, and when the time is right, they'll start deploying cash again. I really like this from the company. Very transparent. Very good. The balance sheet is obviously strong. I think you put out a tweet about it today. It's the benefits of having a pristine balance sheet. You can weather all these kind of economic downturns, and that's kind of what this feels like to me. It feels like it's a bit of a buying opportunity for T. Rowe Price.
and I share that. So I was not buying T. Rowe Price yet. I wanted to wait for the annual numbers, for these quarterly numbers, and I wanted to know how bad it was. Yeah, because I knew it would be bad. It was predicted. We know it follows kind of the market prices, right, with assets under management. I saw the declines. I saw the decline in earnings, and I felt like dividend is still really well covered. Balance sheet is still awesome. Everything is covered. So I bought some additional shares today at, what is it, $113.
Yeah.
Because I feel confident. I feel confident with these numbers at the moment. And yeah, for me, T Rowe Price is like oil. You need to buy it at the bottom of the stock market, and the company manages their dividend like that, that at the bottom of the stock market it's still covered. They don't need to go in debt. That's their whole management philosophy here, while at the same time they're just continuing to make sure that they stay in competition, that they're not getting outdated. That's why they're looking at ETFs and such as well here. So for me, it's a really, like you said, and you can read that, right? When you read this press release, you know that they are not like John Stinky from AT&T. We didn't even mention it here, but he had horrible numbers, and then he applauds himself for how good they did and how they, I think, even mentioned like work above expectations. You don't hear that from T. Rowe Price. They know what
No.
their investors need. They know what the single metrics are to analyze this business, and they are really, really sober and direct in their commentary. So it gives me a lot of trust that they are actually the right captains of that ship. So I decided to join them a little bit and buy a few shares again.
Yeah, and I think asset management companies like this are going to struggle a little bit in this environment. I don't know about Blackstone's earnings. I know they are out, so I'm going to do that separately because I have Blackstone in my portfolio. But I imagine it might be something similar, and I really
Yeah.
think that this will create a good opportunity to buy these companies, and I think maybe for the next quarter as well, because I don't see it improving in the short term. Maybe towards the second half of the year, we might start to see an improvement. So I think between this quarter and next quarter, I think T. Rowe Price might be an excellent choice to start building a position in.
Yeah, and let's not forget 36 years of dividend growth. They have survived the dot-com crisis, the financial crisis, which was in the financial institutions that they were part of. They've been always growing the dividend, right? So these companies are set for the long term. Well, since when does this company exist? Was it 1937 or something like that? Or
Yeah,
1960? Really long, really decades, decades, and decades. So this company, no, I wouldn't be surprised if you are a CEO there, or you join as a CEO. The first thing that you get is kind of the T. Rowe Price playbook. This is how we deal with crises.
yeah,
This is why we don't leverage the balance sheet. This is why we do this. This is what I imagine at such a company, that it's
yeah.
all done, written for you.
They,
Don't do anything stupid. You will be
yeah,
wealthy as a CEO, and
yeah.
move on.
I mean, they tell you everything, even the dividend. They address that. They tell you our balance sheet remains strong. We paid this amount of dividends, and they're just reassuring you, okay, we're committed to this dividend. They then also go on to tell you, okay, our growth equity strategies will continue lagging performance. They're telling you this quarter, the next quarter is going to be tough.
Yeah.
Um, but they also tell you how they're going to get out of it. So I honestly, I recommend anyone not to even read the whole report. Go on and read the company commentary, the management commentary section. It's about a page and a half long, but I think it's worth reading.
Yeah, definitely, definitely.
Okay, let's move on to some of our listeners' questions. And the first one is from Johnny K. Vu, and he's a new member to our Facebook group. And he has asked us what are our goalposts. So his personal ones are, first of all, a day's wage, month's wage, 6 months of wages, and then 1 year of wages.
I really like this kind of staircase model because it gives you milestones and it gives you times to pop champagne bottles, right?
Yeah.
So my goalpost was always first to get, it sounds a bit awkward, but to 100,000 euro. Why this goalpost? Because you always hear from the famous investors that the first 100K is the most difficult, but also the moment that you feel the compounding for the first time, really to its the power of it. And yeah, I reached that stage already, so I can confirm that. So that was my first one. Now, my goalpost is 1,000 euro a month. I call that the freedom dividend, because then you really have a cushion that if you get fired, you can at least pay for the basic needs. And then, of course, you need a bit more, but then you can even work in the kitchen and earn the rest of the money to survive, yeah, in this economy. So that's how I look at that. And then, yeah, my third one is just being financially independent.
Nice one. Yeah, my ones are quite similar to Johnny's actually. My first goal was to get to 100 a month, which I've passed. My next one after that is 500 a month. After that is, I think, 1,000 a month is a goal all dividend investors go for, isn't it? 1,000 a month is 12,000 a year, and then after that, I'm looking to replace my complete income in dividends. So they're my goalposts. I would consider myself successful when I reach my current annual wage in dividends. Good question, though. I do really like those types of questions. Russ has asked us, do you analyze your personal family finances like those of the companies you analyze?
Yeah, definitely. I do it on a yearly basis. In the past, I did it on a monthly basis, then on a quarterly basis. But over time, you get into habits. Yeah. So if you reduce your spendings already, you know what you're saving, and you pay yourself first, it's quite predictable what you do in the end of the year. So I do it now once a year. I make up my own balance sheet. So I know exactly what is on the asset side of the balance sheet. I know what the liabilities are. I know what the equity is, which I call net worth. So yeah, I manage it like that, like a balance sheet. And then I look at my monthly cash flow, which is kind of the pay yourself first principle. And I look at what, for instance, a salary hike as a contribution to future upgrades of the pay yourself first philosophy.
Nice. I have to admit that I did not, but we spoke, and I don't know if it was on the podcast or was it when you were here, but we spoke how you analyzed your spending for roughly, was it a year, 2 years? And that has actually inspired me. So I've started to do that with my wife. I shared my presentation with my wife at the start of the year with my goals. I think I showed you as well. And she's genuinely quite excited about reaching our financial goals, investing, saving, and paying down the mortgage. And we almost
Really
have
great.
a weekly discussion on it now. And it's actually, she's a bit of a slow burner, I'd have to say. So in the beginning, she left me do my thing, but I can really start to see the interest more and more and more coming into it. And every month she's putting, actually every 2 weeks, she's put money into her investment account and showing me and saying, okay, what can we buy? And it's
Nice.
great. But to answer the question directly, I haven't in the past, but inspired by you, as nearly always, I'm starting to track it and treat it more like that, because I'm committed to reaching financial freedom as
Yeah,
fast
and you
as
just need to get into the habit. I mean,
exactly.
my wife overspent on her salary a bit last year. We analyzed it. We know where it is, and she took already action. So once a year, because if my wife, if I do it every month, she will not be supportive to this. It will drive her nuts, and she will think I'm a Scrooge. Yeah. So that makes no sense. But once a year, just looking, because what I also see is like sometimes when I talk with my wife, she might have the impression like I need to cut on buying shoes or clothes. No, why would you do that? Yeah, these are not the big expenses. These are really not the big expenses. So that's why I like to look at the annual base. At annual base, you can just see where did the real money go? Oh, wait a second. I spent 20% on let's say holidays, discretionary. Okay, but do we really need to spend 20% of the annual income, let's say, from her salary on holidays? Yeah,
Yeah.
is there something else we can do here? Oh yeah, wait, we went 5 times somewhere or something like that. Maybe we can just do 2 times this year and take more like weekend trips, and you save already a lot. So while still enjoying the life of being on trips, right? So and then you don't need to take those little things where you're penny wise pound foolish. I mean, you you don't save a lot from going from potatoes to ramen noodles. Yeah, that's not where the opportunity is for saving. Yeah. So makes no sense
I,
there too.
I love that quote. You don't say without going from potatoes to ramen. I'm using that. No, but I understand, and it's always a balance, isn't it? To enjoy the moment, enjoy the now, while trying to set yourself up for the future and reach your goals. So I
Yeah.
think it's always a fine balance, and the best way to do that is to treat it like a business, to see where your money is and how you can best optimize and put your money to good use.
Yeah, definitely.
Um, Thanks, Russ. Great question. Drip has asked us, what were your top 3 episodes in 2022? So I can tell you the top 3 episodes that we have. It's episode 131, which I don't know if that was 2022 actually, but it's episode 131. Typical stocks for an all-weather portfolio is our best ranking episode.
That was 2 shows ago.
Yeah, 2 shows ago.
Yeah, that was 2 shows ago.
Okay.
Where have you been with your mind? This was the vodka show, I think. The
Yeah,
vodcast. They
you
call
see,
it the
that's
vodcast.
That's why I don't remember it. Okay, let's move on to the next one. Episode 115, invest in high quality stocks. And the other one was episode 116. Directly after that was a cheap pound, 5 UK dividend stocks.
Yes.
Those were our top two in 2022 and our top one in 2023.
Yeah. So I don't know if it was in 2022, but I also really enjoyed Cameron Stewart. Yeah, it was last year. I
Yeah, that was
really
last year.
enjoyed having Cameron Stewart, and also the dividend guy Mike with his French accent. He was really, really, also really great. It was a good vibe in the show, but also we had Alex, we had Mike. I really enjoy those interviews, and I actually really like it when community members are in. And we have one of the community members also that I think it's Maurice Everts that volunteered. So Maurice, when you're listening, I know I didn't reach out to you yet, but you are booked. We want to do a guest monthly. So we will reach out to you like 2-3 weeks before to settle on a date, and we'll get you on the show. Definitely, the offer still stands.
And saying that, you're going to appear on Dividend Guys podcast soon, I believe, as well.
Yes, we will record. I think around 4 February there that
Awesome.
weekend.
Awesome. I do really like Mike. I think he calls himself the passionate investor, and if you sit down and speak with him for 2 minutes, you will really get that vibe from him. So I recommend checking it out, but 100% tune into the podcast when you're on it. Okay, Bert has asked us, what do you think about the trend of rising inventories at many companies currently? And do you take this into account when making a discounted cash flow model?
Yes and no. Look, rising inventory levels, you need to know that this is an accounting item on the balance sheet. So that doesn't mean necessarily that they have, let's say, more on stock. Yeah, here, so more items on stock. Often it is just like the cost of importing those inventory just went up by 20%. This is the inflation. If this inflation is a one-off, it's usually priced into the current free cash flow. And that's why at the moment I not necessarily look at the inventory. I'm little bit more conservative with the growth numbers in free cash flow that I model. And because of the interest rates, I'm now asking for a higher discount rate instead of 10%, 12.5%. So that's how I do that, Bert. Because it is mostly the inventory are up because of inflation, not necessarily more items on stock. Of course, some companies might have that, but it's mostly across the world. It's around inflation.
Good answer. So the last question is from Herman, and he asks about our opinion on ticker symbol PKG, Packaging Corporation of America.
Oh, I looked this one up when I saw it, and I actually really, really like what I saw. So this company actually has a 3.6% yield, so that's already good. A PA ratio of 12.5, which is also good. It has a proper dividend history. I don't remember the amount of years by heart anymore, but it passed all my screener criteria. So I'm intending to do more of an analysis here to start really looking into the latest quarterly report, annual report, and see if I still like it after that. So study the business a little bit. But I just actually wanted to thank him for bringing it to my attention because I never heard of it. And it passes all my screening criteria. It's a boring business, also nice. So yeah, I'm interested.
Yeah, I guess this is brought up because I talk about Sunoco quite a bit, and also the lovely Irish company called Smurfit Kappa, and I'm guessing these guys fit into that same kind of category. I have to admit, I don't know a whole lot behind the company itself, but like you, I've ran them through my screener, which I use Kaifin for, which is great because I get it all on one page, and yeah, pretty much it would pass all my screeners. You can see free cash flow has been growing quite nicely. Dividend per share has been growing nicely. Long-term debt seems kind of flat. It doesn't seem rising or falling over the last 10 years. So overall, it does look like a nice company to analyze, and could be nice to have a second company of that nature in my portfolio. So again, like you, I'm intending to look into this a little bit more. And you might have noticed I've got rid of my blog at Engineer My Freedom. I've started to write on Dividend Talk because we post all our episodes there and blogs. So I wrote about Walgreens, and I might write about Sunoco next and put these guys in with them. So yeah, good one, Herman. It's a good choice. Okay, that's the end of the show. It was quite quick. We are rushing off to dividend day. It's Intel earnings as well, so we have lots of people from the community that will join us. I cannot wait. I know this podcast will go out too late for people to join, but we always send a link out on all our social media, so I can't wait to see everybody in there. As always, thanks for listening to us. Please engage with us on Twitter, on Facebook, on YouTube, and both of our blogs. Everything is really appreciated, and we will see you all soon. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.